Oil highest since January. Yields are up, maybe on the oil surge. An inflationary move there. The dollar's higher on the safety trade. The gold is highest level since April. And then you have UBS saying, try to look past what's happening here, that the impact on the market should fade fairly quickly. That's what they suggested. How do you see it?
Look, I've been in the business almost 35 years. We've seen a number of flare-ups in the Middle East. Every single one of them has been buying opportunity. Now, there's talk that this time will be different because it's going to go on for possibly 2 weeks. But at the end of the day, the result's the same. And I think you see it in the recovery of the indices today, particularly in NASDAQ, that that's the case. I'm not concerned about oil. If I were a trader in oil, I would have sold the pop. I'd probably still sell it. And it was clear, and Trump admitted it recently, that the U.S. knew about this.
Well, oil was trading over the last at least week as if the market, quote unquote, knew something was going to happen, because you had a bid and a bid and a bid and a bid, and now you get the spike on the actual news.
Right, and despite that, it's a great point, despite the Saudis continuing to say they're going to pump and pump and pump. So, look, I wouldn't be surprised if they were saying that to calm the markets in advance. But here we are, the Saudis, who are also not friends of Iran, will do what they need to take oil prices down. But even if they don't, the Fed is not going to look at oil prices and say that that's going to derail us from whatever they were going to do. It's going to be a non-factor. It's transitory, as they'd like to say. So it was a good opportunity to at least trade this morning, and I sent that note to you and the others at CNBC, and I think it's business as usual.
Surat, a destabilizing move is never easy for the market to initially digest. It's sort of knee-jerk, and then dust settles, so to speak, and then you kind of figure out what the longer-term implications of everything are. How do you process the news in your thinking about where we are? Again, we came into today 2%, and even with this move, we were less than 2. Now we're just barely above 2% away from a new high.
Yeah, look, I mean, in terms of oil and gas, too, it's a great diversifier in your portfolio. So we have about 5% of our portfolio in there. It's there for a reason with high-quality oil and gas companies. So if you're a trader, yes, but this is also why, as a long-term investor, I have those stocks in my portfolio, and as well as gold. So, but I think Steve's right. You look through this,
So you believe UBS. Market impact should fade fairly quickly.
I think you do. And you're going to get a reaction at some point in the Middle East, and it'll go back and forth. I don't see oil kind of going back to that 45-50 range in the short term just because of this overhang.
I mean, if the Strait of Hormuz is open now, but if there's a move there and that closes, people that we talk to say, well, you're looking at $100 again.
Yeah, I mean, it could pop at least in the short term. So, why do we have certain things in our portfolio? When you have a diversified portfolio, you keep these things in there and you buy them high quality companies.
Shan, impact should fade fairly quickly. Is that how we should think about this? Our viewers, our trading public should think about this? Again, 2% from all-time highs on the S&P?
Well, I think, you talk about that level, and is there some vulnerability just based on where we're at? There's a lot of factors to think about here. Scott, one thing that I don't think has been mentioned yet, at least in this conversation, is that, yes, I agree with Steve, kind of the temporary impact is likely to be faded, and, certainly in oil prices, there's likely to be some excess capacity that can come on and offset some of the price increases. But I think more importantly, you think about sort of the arm's length players in this conflict, the U.S., Russia, and China. And there's some other very important negotiations that are going on between U.S. and China right now that I think have some significantly more implications, significantly greater implications for the global economy. And so, if there was, an escalation where there becomes additional combatants get pulled into this conflict, and particularly around the U.S. and China, Russia has a conflict of its own that it's grappling with right now and is probably a bit too busy to get heavily involved here. I think that any implications around the potential for this to derail or delay further negotiations with the Chinese, I do think that that would be something that could potentially make this a longer tail than what we've seen historically.
Rob, as a market participant, what are your thoughts on the market today? Not overreacting in the price action would tell you that. If you look at the S&P, for example, not even down 0.5% at the time. It seems like it's trying to focus on the broader theme of what UBS is suggesting. Don't do anything rash in the market, that this is soon going to pass and just be another one of those major flare-ups in the Middle East that over the longer period of time doesn't necessarily impact all but, a few or a couple even asset classes in our markets. And even that is only for a reasonably short and fenced-in period of time.
And if you look at any history, it would tell you exactly the same. But this time, Scott, I think it's all about oil prices. And if oil prices are contained, markets will move on and they'll focus on whatever the next event is, and that might be short-lived too. But this could throw a wrench in both the economies and markets. Higher oil prices have a lot of implications because they're inelastic. It's a tax on consumers, and it crowds out spending in other areas. It could make headline CPI reaccelerate. Remember, oil prices have been a source of disinflation over the last 3 years, and obviously the opposite direction would not be welcome. And higher energy prices constrain the Fed. There's 2 cuts priced in, and this oil prices being much higher makes Waller's good news cuts rather unlikely. There's obviously a lot of uncertainty of whether they'll sustain higher because there's a lot of latent supply. It's still abundant, but it definitely has the possibility to slow demand. I think the one interesting thing that no one talked about is how when something like this happens, we have often seen a positive reaction in treasuries. And we have not seen that this time, despite seeing it in the dollar and despite seeing it in gold. So what does that mean for markets? Is the era of U.S. exceptionalism really over? Is international going to continue to do well? I think it's the derivative effects of this that we should be paying attention to.
Unless it's just reacting to the move in oil as an inflationary byproduct of the move there. Your point's well taken, but it's just too hard to know. If there are moves to be made today directly related to this outside of just straight equity decisions, Bill Baruch seems to have found some. He joins us now on the phone because he does run a commodities fund, and he is making some moves in both gold and oil. Can you tell us what you're doing today?
Yeah, the moves really sort of started permeating through the week. Early on in the week, news that the U.S. may evacuate embassies in the Middle East, particularly in Iraq, with not a whole lot of context around it. So gold start to react, crude oil began reacting very quickly. You look at some of that starting to happen, and the fact we didn't get context around it, I think is very important. And then lo and behold, we start to get these moves. Volatility overnight expanded rapidly. Option prices in gold and crude oil. So what we were looking at is being positioned in those, really capitalizing on it, exiting call spreads in crude oil, exiting call spreads in gold, looking at monetizing this move ahead of the weekend because I think the news flow is going to continue to evolve. And on one hand, I do think there is potential to see continued talks. President Trump took the Truth Social earlier in the day, talking about today being day number 61. He doesn't want to see those high oil prices. So I think these conversations will continue to go. Coming out of the weekend, we could see a little bit of a different situation. So if you're trading this, I think it's important to capitalize on these moves. If you're a trader right now and if you've been long crude oil or you've been long energy and some exposures there, it's important to capitalize on it and look to move on, but also be ready to see what next week brings.
What about gold?
I love gold overall. I think this move is building up for 5,000. I mean, it's a very nice consolidation. We could get a record high settlement in gold today. What I really love seeing as well is you're starting to see silver, platinum, and some of the others wake up. But gold, as it's moved very well through the middle part of this week, it's important here, too. We're looking at monetizing it ahead of the weekend because some of these weekend moves, it's almost like the week loses a bit of memory from week to week, and you want to be prepared for that news to evolve. So, again, if you're long gold and you're trading it, capitalize on it here, I think is very important. Now, in our portfolios, in our diversified portfolios, we have exposure to gold, miners, midstream energy, commodities, in about 10% of the portfolio for the exact reason that you hit on and Rob hit on, that the Treasury market, if you have a fixed income portfolio, is not reacting properly here right now. There are some good auctions this week, and still we fell out after this news on inflationary fears. So we couple our fixed income with this real asset basket. As an investor, we're not touching that today. We want to see that continue to work for us. There's cash flow from a lot of those assets too. So it just depends. What hat are you wearing? Are you wearing a trader's hat or are you wearing an investor's hat?